Welcome to this explainer. You know, the global nonprofit sector handles literally trillions of dollars every single year. But how is all that money actually tracked? Well, today we're going to do something highly practical and honestly incredibly useful. We're going to translate traditional business accounting principles into the specific dialect used by nonprofit organizations. The good news? If you already know the basics of business accounting, you've got the foundation. We just need to remap it a bit.
Picture this. You've just been elected treasurer of your local community club. It's a huge honor, right? But suddenly you've got actual funds to manage. Proper accounts absolutely must be kept to ensure transparency and, avoid any awkward accusations of fraud. But here's the puzzle. Let's say your club brought in $5,000 more than it spent this year. Since there were zero business owners to take a profit, where does that money actually go? Who owns the bottom line?
To answer that, we're going to follow a clear financial roadmap today. We'll be covering 1. Nonprofits versus businesses, 2. Tracking the cash, 3. Calculating the surplus, 4. Club side hustles, 5. Sorting out subscriptions, and finally, 6. The accumulated fund. Let's jump right in.
All right, Section 1, Nonprofits versus businesses. Let's establish exactly who and what these rules apply to. Whether it's a social welfare group, a local drama society, or a golf club like the one pictured here, these are fundamentally non-profit-making organizations. They're often run largely by dedicated volunteers. And unlike a traditional business, which, let's face it, exists primarily to pump profit back to its owners, a club is entirely about providing a service or facility for its community. That fundamental shift in purpose completely changes how we report the math.
Now, what's really fascinating here is how we kind of have to translate our traditional business accounting vocabulary into this non-profit dialect. You don't have to learn a whole new system of math from scratch. You just have to learn the local language. For instance, what a sole trader calls a cash book is known in a club as a receipts and payments account. As we go through this explainer, you'll see a few more of these crucial translations.
Okay, moving on to Section 2, Tracking the cash. Let's see how this builds on what you already know.
Take a look at the Champion Sports Club's Receipts and Payments account. It's simply a summarized version of the cash book. All the money coming in, like those $9,000 in subscriptions, entrance fees, and donations, is debited. On the flip side, all the money going out, stuff like rent, electricity, and even a $30,000 hit for new sports equipment, is credited. There's no distinction made here between cash and bank transactions, and zero adjustments for prepayments or accruals. Honestly, it doesn't matter if an expense is capital or revenue. If the cash moved, it goes on this statement.
Which brings us to Section 3, Calculating the surplus. Because raw cash doesn't tell the whole story.
As any good accountant knows, just looking at cash flow doesn't tell us if the club is actually financially healthy for the year. So let's do another translation. In a standard business, you'd calculate a profit for the year or a loss for the year. But since clubs don't exist to generate profit, we use different terms. If the club brings in more than it spends, we call it a surplus of income over expenditure, or just a surplus for short. If expenses outpace income, that's an excess of expenditure over income, otherwise known as a deficit. And any surplus made isn't passed out to owners. It stays locked right inside the organization.
So the absolutely crucial point here is that the Income and Expenditure Account acts exactly like an income statement for a regular business. It contains only revenue, income, and expenditure for that specific year. This means we have to play strictly by the accruals principle, adding in accruals and subtracting prepayments. We completely ignore massive capital hits, like buying a whole new clubhouse, but we absolutely must factor in silent, non-cash items, things like depreciation on your gear.
All right, Section 4, Club side hustles. What happens when a nonprofit runs a profit-making venture?
Lots of clubs rely heavily on fundraising. If your club runs a continuous side operation, say the Aces Football Club Cafe, you have to prepare a separate trading account. This works exactly like a sole trader's trading account. You take the cafe sales, subtract the cost of sales, adjusting for opening and closing inventory, of course, and then subtract staff wages. You're basically calculating the specific profit from that cafe first, almost like putting it in its own little financial bubble, and then transferring that final profit directly over into the main income and expenditure account.
Next up, Section 5, Sorting out subscriptions. This is the big one.
We're hitting the one major adjustment that is entirely unique to the nonprofit world. You will literally never see this in a sole trader's books. Subscriptions are the absolute lifeblood of most clubs. It's the regular fee members pay just to belong. But here's the tricky part. Humans are forgetful. Some pay late, and then you have those overachievers who pay a full year in advance.
Because of the matching principle, we can't just record all the cash we received. The income and expenditure account must strictly reflect only the subscriptions relating to the current year. And this brilliantly illustrates how we handle those timing differences using a subscriptions account. Let's say a member pays for next year right now. That's a subscription in advance. We actually have to treat that as a current liability in our statement of financial position. Why? Because for a short time, the club effectively owes those members the service they already paid for. Conversely, if a member hasn't paid yet, a subscription in arrears, that is treated as a current asset, because that member legally owes the organization money.
Finally, Section 6, the accumulated fund. Let's look at the ultimate bottom line.
In a standard business, the bottom section of the balance sheet is all about capital, the owner's investment, and their drawings. But in a club, there are no owners to invest capital, and members are absolutely not entitled to take drawings. There's no taking cash out for personal use. Therefore, the equity section is entirely replaced by something brand new, the accumulated fund.
The accumulated fund is, well, exactly what it sounds like. It represents the running total of all the wealth the club has generated over its entire life. You take the opening balance of the fund, add this year's annual surplus, or, unfortunately, subtract this year's deficit, and that gives you the total accumulated fund. Think of it as the community's collective nest egg.
This means our fundamental accounting equation shifts just a tiny bit. You're probably used to hearing capital equals assets minus liabilities. Well, for our nonprofits, the golden rule becomes accumulated fund equals assets minus liabilities.
When you put the whole shebang together, handling those ancillary cafe inventories, calculating the depreciation on sports equipment, and correctly adjusting for accrued and prepaid member subscriptions, you end up with a perfectly balanced statement of financial position. Take an organization like the Animal Sanctuary Society represented here. Their physical premises, sanctuary equipment, and cash balance perfectly against their current liabilities and their long-term accumulated fund.
So, we've successfully mapped standard accounting principles over to the nonprofit world. You now know how to track the raw cash, adjust for the matching principle with tricky subscriptions, and roll it all up into the accumulated fund. Now that you've learned the local dialect of club accounting, the only question left is, how will you use this financial literacy to protect and empower the causes you actually care about? Are you ready to step up as your community's treasurer?